Okay. Good afternoon, everybody, and welcome to today's webinar, Expand Your Real Estate Reach, Investing in Mortgage Notes Through Tax Advantage Retirement Accounts, presented by Next Generation and Scottsdale REI. I'm Erica Figueredo, the marketing specialist here at Next Generation, and before we get into today's discussion, I just want to review some housekeeping items, give you some information on our speakers, and tell you a bit about Next Generation. So as always, today's session is being recorded for anyone who didn't have a chance to make it live. And for those who are here with us, welcome. If you are here with us live, it's great to have you. Everyone joining today's session is going to be automatically muted for the entirety of the session, but that doesn't mean we don't want to hear from you. So I'd like everyone to just take a brief second to find your Zoom control panel located at the bottom of your screen. And what I'd like you to pay attention to is the chat and the questions tab. So if you have any questions during today's session, please use the questions tab, and all other conversations, feedback, etc., can go into the chat tab. That's also where I'd like everyone to take some time. Let us know who you are, where you're from, why you're joining today, and if there's anything else you'd like to learn. So we want to keep this engaging as possible, so feel free to chat amongst yourselves. For today's conversation, we have our co-host, Jay Tenenbaum, founder and president of Scottsdale REI, and alongside him, we have our very own Brittany Melville, Next Generation's Director of Marketing and Sales. I'll get to them in a little bit so they can introduce themselves and you can get to know them a little bit better. But for now, I'll tell you a bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans. And these plans are much like the plans that you would find at any brokerage. The only difference between them being the types of investments that can be held within them. So instead of investing in stocks and bonds, and other publicly traded assets, self-directed IRAs give investors the opportunity to hold alternative investments within a tax-advantaged retirement vehicle. So this is anything from real estate to private equity, notes and loans, cryptocurrency, which has been hot, precious metals, and much more. These accounts provide a hedge against stock market volatility. They allow investors to diversify their retirement portfolios, and they give them better control over their investment returns. There are two arms of our business. The first is our administrative arm and headquarters, Next Generation Services, located in Roseland, New Jersey. Next Generation Services handles all of the back office administration, record keeping, mandatory tax reporting, and transaction support for all of our client accounts. And then we have Next Generation Trust Company, located in Sioux Falls, South Dakota, which is a licensed and chartered trust company, which serves as custodian for all of our accounts. And the accounts are named with Next Generation Trust Company as custodian and holder of assets for the benefit of the individual account owner. So to give you a very necessary disclaimer on what we don't do, we're not a bank or fiduciary, so we don't provide any financial, legal, or tax advice. And we also do not endorse, recommend, or review the merits of any investment. So with that being said, any information provided within today's webinar is for educational purposes only. So now I'll hand the floor over to our hosts for some brief intros. So Britt, why don't you tell us a bit about yourself?
Sure. So nice to see everyone, or meet everyone, I should say. I don't see you all. I'm Brittany Melville, the Director of Marketing and Sales here at Next Generation. Erica is one of a few great members of our team that assist to provide education and onboarding for investors looking to use self-directed IRAs. I've been with the company about 5 years, and we are a women-owned business in New Jersey, as Erica had mentioned. So we're very focused on education, do a lot of these webinars. I'm glad to be talking with Jay here today about notes.
Thank you, Britt. And over to Jay. Why don't you tell us a bit about yourself?
Thank you, Erica. Good day, everyone. My name is Jay Tenenbaum. I'm with Scottsdale REI. Scottsdale REI is a private equity real estate investment firm. We focus primarily on buying distressed mortgage notes all over the country, nationwide. We've done it in about 38 different states. I've done about 450 deals since I started investing in 2013. I was a debt collection attorney before that and became a real estate investor ever since. And we're just investing in opportunistically all over the country, helping people in their homes and creating passive wealth and cash flow and legacy to our investors.
Thank you, Jay. So now we can get started. So back to you, Brittany, for today's discussion.
Okay, thanks, Erica. So before we jump in, just wanted everyone to know that when you signed up, we did ask you what you were looking to learn. So we wanted to let you know that we did review that information, and we tried to make sure that our discussion today will incorporate some of those things that you guys wanted to focus on. But we did kind of get everything from, how notes work. So people that are newer to understanding notes and want to get the basics, to how does it work in a self-directed IRA, tax implications, et cetera. So we're going to try to cover as much as possible today. But Jay, let's start with you, the note expert. And could you talk to us a little bit about high level how mortgage note investing works, and how do you find these distressed notes?
Certainly. So when you're buying a distressed mortgage note, you're not buying the property. You're not buying the four walls and a roof. You're just buying paper, right? You own, so you go to somebody goes to buy a house. They sign a promissory note and a mortgage. The mortgage secures the property, secures the bank's interest in the property. At some point in time, you, the homeowner, stop paying. For whatever reason, it doesn't really matter. And then these notes are then made available, basically, when in this present industry, you have, you buy a home, you take out a loan, that mortgage originator, Bank of America, Wells Fargo, pretty much sells their loans, even performing on the secondary market right away. When they go into default, it gets bought and sold as a commodity. So basically, Goldman Sachs gets a hold of it, pays 8 figures for a variety of notes, not just one, not just John Q. Homeowners Loan at 124 Main Street. It's a variety of notes in a bundle. And those get sold to another hedge fund, and it gets packaged out as a commodity, to where it gets to investors like ourselves, kind of the smaller guys who actually will take the time and actually work the note through. Finish foreclosure, start a foreclosure, talk to a borrower, do a loan mod, whatever that takes. That's what we're acquiring. We're taking the note and we're going to start to do something with it, create that value add somewhere, depending on what's available to us. As far as where you find them, I've been in this business since 2013. I kind of developed the moniker of I'm lazy, I don't like to hunt. So I've developed relationships with banks and hedge funds all over the country who bring us deals on spreadsheets on a pretty regular basis. And so as you're just starting out, it's, we have the opportunities to bring you the deal flow. So you don't have to do the heavy lifting, because it takes some time to find, just go to call up Bank of America and go, I want to buy a note, right? You got to kind of know the sellers and who they are and the sourcing. And that's a full-time job for us as well.
That makes sense. And given current market conditions, can you comment on kind of what you're seeing? I would imagine that we're expecting foreclosures to kind of explode at some point in the future, now that some of the protections around during COVID times are sort of waning. But can you comment on anything that you've seen or that you think we might foresee?
Sure. We are in crazy times. Unprecedented. Like you said, okay, the crash of 2008 was never happened before. And now we're in a time that we don't know. It's got a variety of moving parts, and it's really, we keep our pulse on it, yes, but it's a variety of moving parts. So let me kind of break it down a bit. So with the moratoriums ending, you're right, Brett, moratoriums have ended. The forbearances that people were on are expiring. The economy now is these people have equity. Unlike 2007, 2008, when the bottom of life fell apart, everybody was underwater. So they got foreclosed on dramatically because they had to, because they couldn't refinance or do anything else. Now everybody's got equity in their house primarily, right? We've just skyrocketing prices like nobody's ever seen. And demand is crazy. Supply is short. Supply is almost non-existent in most markets. And so you're gonna, right, why you say, okay, well, if I'm not making my mortgage payment because, okay, pandemic related, maybe some people still lost their jobs and they can't pay. They won't get out of their way though to sell the house and get out from under it. They'll let themselves get foreclosed on. So that's what you're going to see. Now, the statistics are kind of misleading because you'll say, okay, foreclosure starts have increased since last year. Well, yeah, because nobody could foreclose because of moratoriums. But the volume really isn't there yet because it's just all kind of working itself through. Our market runs very, very slow, right? The bank has got to get a defaulted mortgage on their books and then start selling it off and then start selling it off. So the stuff that is going to be, the explosion of where banks will sell their assets versus foreclose themselves, we won't see that stuff hit the market for probably another year or so. Now, in turn, what's happened in the market is the pricing of houses because of no demand, of no supply, is just crazy. And so we're sitting on some stuff that we've taken back at auction, let's say, and trying to pull teeth to get the construction crews out there have been a challenge. But while we used to be able to say, okay, we'll get our crew out there, we'll get started on rehab in 20 minutes, right? Now it's 2 or 3 months. But during that time, our house appreciated about 100 grand. So now that out of whack rehab budget, because somebody doesn't want to do the job, starts to make sense, right? $200,000 rehab job, we're like, oh my God, you're crazy. Now when the house went from 400 to 500,000, you're like, that might work, right?
Wow.
And with no supply, now in turn, our hedge fund relationships also are acute to that. And they say, well, if I'm selling you notes on properties that's appreciating, now we want more. And unfortunately, in our market, you get a lot of investors who overpay for stuff, who lose their shirt because you can still, even with appreciation, we don't model our business on speculation. We try to get the numbers of where they are today. If it appreciates, bonus. But you get wildcats out there to go, oh, it's going to go appreciate another 100%. Well, it doesn't. And at some point, when it doesn't, the dichotomy then becomes, well, when the market drops, then the discounts we're getting now, we'll get them even cheaper because everything will value lower. So it's all a bunch of moving parts. You just got to stay away from stay abreast of it. But there's bottom line is no matter which is an up market, a down market, a lot of supply, whatever, it's always going to be opportunistic for us, and we're capable of pivoting in the correct direction.
Sounds like an intricate dance.
It is. Sometimes you just got to be lucky instead of good.
Yeah, that makes sense too. Yeah. Well, it certainly makes sense that there's a lot we don't know, but being able to pivot with the changes sounds like the best you can do and the best to be able to be successful. So I'm sure too that depending on what markets everyone on this session is located in, there might be more opportunity in certain areas than others. So if someone's looking at an out-of-state note, how are those managed and what are some best practices for doing due diligence on those, especially for someone who's not in that geography?
Sure. So basically, from up until this recent time frame where everything was easier, building a team in any market was really easy. We typically start with our property manager, or finding a property manager, or finding a realtor to work with to build a team from within. Typically, your realtors when you're interviewing the realtors, believe me, you'll kiss a lot of frogs trying to find the right prince or princess, right? And the conversation usually tells, your retail realtor who only sells, represents seller buyers who buys, luxury homes. That's not your person. You want an investor, a realtor who's investor friendly. They work with investors. They love working with investors. They know how to work with investors. They've got either their own crews or their own referrals, contractor sources to provide to you. I'll give you an example. One of our best markets is Pittsburgh. I was looking at just a random note to buy February of 2021. And what we strive to do is say, it's like, my note is on 1234 Main Street. I try to find, hopefully I can find a house on 1236 Main Street that sold 5 minutes ago. I find out who the realtor was, typically the seller's agent. Buyer's agent's fine too, because it basically gives me an idea as a starting point. They know that particular area, that particular street, because I can run the numbers all day long from afar, and that's easy. But you really want to get your boots on the ground and to know what you're really up against, good or bad, right? Sometimes your values don't make sense because it's a pocket area where the values are better in that area because she knows the market better than you do from afar. But when I called her up, it was on some random property. She was actually listing it for sale and decided to keep it as a rental. Well, who is she now? She's our realtor. She's our property manager. She's our project manager. She's our wholesaler. In addition to that one note, we've exited three, we've started to finish 3 fix and flips. We are closing on one any day, a fourth one any day now. A fifth one is going to go on the market any day now. We're rehabbing a 14 unit with her. We've already bought and finished a quad that we're keeping as a rental, and a variety. I think we bought a triplex the other day that I remember, and that's just from one conversation.
Mm.
Okay, so you develop your teams, and it's easy. And I say it's easy in a hunt and peck and a trial and error way. It's easy, but your team will consist of. And when I said property managers, sometimes when you can't find the right realtor, because sometimes realtors don't understand what notes are, because they want to say, you can't say, I'm buying a note, I still got to take it for foreclosure. They're not getting the instant gratification. They don't get it, right? Or it's not listed on the MLS. Fine. Your property managers, though, they've got the pulse on every area. They know who the right realtors are. They know who the right contractors are, right? So if your realtor can't find your realtor in that peck kind of time, your property managers work just as well. And that's really your starting point. Then you get your ancillary vendors from there. And then we've got national vendors that we use in any market.
Gotcha. Okay. So in terms of how the investment structure works and the logistics, someone buys a note, how do the payments flow back, and with what frequency? Is that typically consistent, or does it depend on the note?
Well, it depends. It depends what you're buying. If you're buying a performing loan, right, it's real simple. You're buying to gain cash flow. You're probably paying a premium for the loan that I don't particularly mind. That's not my investor ID. I'll explain in a minute. But basically, it's really simple because you're buying the loan, you're parking it with a third-party servicer. They're collecting the payments for the borrower, and they send you the ACH. Wash, rinse, repeat. And as long as the borrower is paying, everything's a good day, right? What we typically buy, though, are where the borrowers have stopped paying.
Mhm.
And because we're going to get them at a bigger discount than the paying. And then what we do by that is if we get a borrower to start paying with a loan mod, then we could sell it as a performing loan just like somebody else. That's the value add. Or we keep it for ourselves for the same cash flow. But if I'm buying something for 10 grand and getting $300 a month, as opposed to if I had to take it from non-performing to performing, this is back in the day when I was really buying low value stuff. But if I bought it as a performing loan, right? Say the value of the house about 50 grand, I'd probably be paying 35, 40 grand for that loan to get the same $300 payment.
Gotcha. Okay. So if I know we'll talk about this in a bit, but if someone's using an IRA, we're talking about non-performing or underperforming notes, they don't necessarily have to have a ton of funding to work with to get started.
That's correct. I mean, with the discounts that we get, your money goes a long way. Like, for example, our, real estate community, just give you an example, our real estate community mastermind group that I run, the guys outside of, not having nothing to do with Scottsdale, they've collectively done almost 100 deals and only raised about $3 million. Because if I was investing in a note in California, that $3 million would get me like one or two.
Right.
$3 million spread over 100 loans, you're getting a price point that's like $30,000, $40,000. And you want to be careful. I cut my teeth buying really low value stuff, spending $1, spending 5,000, spending 10. That's not for the faint of heart though, because your houses are only back then in 2013, 14, 15, were only worth about 50 grand, right? And so if you had to foreclose, your investor ID is you can use buying distressed mortgages as an acquisition strategy. But I'll tell you right now, for the most part, unless you're buying the higher value stuff, which is what we buy now, your mentality of I want to buy this as acquisition and I'm going to fix and flip or bust, you're short-sighted, because generating mortgage loans as, generating cash flow out of them as loan mods, or taking them back and then renting them, or taking it back and doing seller finance, creating the cash flow out of these is really where the value in investing in this stuff is.
Gotcha. And it's really passive in nature, right? For the investor.
Yeah.
There's not much that they're managing.
Correct. I mean, Scottsdale, we're considered the industry as a sponsor or operator. That's kind of the term of art. We found the asset, we've done the diligence on the asset, we're going to manage the asset, and just attractive returns to our investors.
Gotcha. So we sort of talked about, unless there's anything you want to add on this typical investment structure. Did we cover everything you wanted to say on that?
So with investment structure, I mean, we've evolved from going to JV agreements, which is basically saying, I'm investing, Brittany, you're going to invest in a certain identifiable node or package of nodes just individually with me, with Scottsdale, right? Now, and we're buying the low value stuff, $50,000 used to get you 3 or 4 nodes, and the diversification was great, right? And then we kind of leveled up a little bit, and now we're buying loans. Our average purchase price is $100,000 to $200,000, and there isn't a bank necessarily that says, sure, I'll go get you a loan for 90% of that, right? So you're raising it with private capital, IRA money predominantly, right? And so now, I'm not having to go out and find the investor who's got $200,000 sitting in their IRA. I can go out and put a member managed limited liability company and do what we call a syndication, and get 4 or 5 guys who got $50,000 in the IRA, and we all join in, and we're all a member managed LLC, and we're taking down that asset or pool of assets.
Gotcha. So in that case, in a syndication type structure, the IRAs be limited partners, or?
They become a member of the LLC. There's
Okay.
a class. Scottsdale is administrative member, which we're considered a Class B member. All of the investors contributing capital are the Class A members, but you get a membership interest in the limited liability company. And from there, that's just our typical structure. And then also we're setting up our fund where basically it's just a passive. You're getting at a certain preferred return, and then a certain piece of the profits on what the entire inventory of Scottsdale looks like, not just kind of moving away from specific syndications on specific assets and saying, here's what Scottsdale owns, and here's what's going to grow, and you're going to buy, you're going to sell, you're going to buy some more and sell. So the whole performance of the company will be in this fund that they're investing in with us.
Okay, so even with then some, like on the IRA side, even with somewhat limited funding, they're getting a more diverse exposure to a set of assets.
It's kind of like real estate investing, like you're buying ETF. You're buying everything. This fund is going to be owning everything that Scottsdale acquires in the future. And as we sell stuff, you get distributions, and as we buy more, sell more, is all the performance of the group.
Got it. Okay. And as far as the investor's role, we already determined it's pretty passive. Is there anything else that an investor would be expected to do if they were to invest?
In the syndication, you have, because it's member managed, not a manager making all decisions. The high level decisions are made by the membership. So when we decide we're going to go to auction, what's our opening bid, or we're going to do a fix and flip, here's what the budget looks like, here's what the opportunity looks like, here's what decisions we're going to make on exits. Then we have a meeting on our syndications with our investors to make those decisions. In those syndications, again, it's a question of how you want to scale. In your syndications, we've only got 2 to 5 members, so it's easy-ish to have that conversation. Now in the fund, our fund managers will have more decision making. It'll be strictly more passive, because you can't call 500 people into the fund and say, let's make a decision on what to set the bid at.
Right. Gotcha. Okay. Thanks, Jay. I saw that we had a question pop up. Maybe we could address that now. It seems relevant to the conversation.
Yes. So we have a question from Miss Olive Ross. She'd like to know, once you buy the note, how difficult is it to foreclose?
Not at all. We've got our own network of attorneys that we use, and we've invested in over 38 different states. So for the most part, I know who my go-to attorneys are in all those states. So you buy the loan, you've done in your diligence, you kind of get some of the story or the majority of the story, what's going on, how far behind they are. You haven't made any contact with the borrower yet during diligence, but you've examined all the pieces of investigation you want. The payment histories of the servicer notes, make sure you actually got a first position mortgage, you're getting if there are any delinquent taxes, things like that. And then once you own the loan, you can decide what to do. You could try to contact the borrower and see what they want to do. Do they want to continue to pay and get reinstated on a loan mod? Do they want to give you the house back to save themselves the stress of foreclosure? Or you just engage your attorney and you just push the button and off you go. And every jurisdiction that every city, state, county that we invest in, we have some idea of the length of time. And as I said before, as we invest opportunistically, we're buying notes at all stages of foreclosure. So we bought notes before that went to sale 2 months later. We bought plenty of stuff in my career that we haven't started foreclosure at all, and anywhere in between.
Great. So I think we could flip the script now. Jay, you had some questions for me, a little bit more deep into the IRA piece.
Certainly. So tell us what a self-directed IRA is and why should an investor consider using one?
So for anyone on the line who is not familiar, I'll just briefly explain. And Erica really did a good job of explaining it as well, so I probably don't have to get into too much detail. But essentially, it's a retirement account that might work like any other from a tax implication and setup perspective. But the main difference being what you can invest in, and that being that it's not limited to publicly traded assets like stocks and bonds. So typically, self-directed IRAs are not managed by an advisor. They're just completely open for the investor to choose their own investments and have full freedom to decide what they want to hold. Obviously, within IRS limitations, but again, it could include, real estate, private equity, notes like we're talking about today, as Erica said earlier. The reason why someone might invest through an IRA versus just using personal funds, there are a few reasons. So one is the obvious tax advantage. So when you're using an IRA to make these types of investments, you're usually doing it for the long haul because you're funneling it through a retirement account, which is going to pull in your investment returns directly back into the account, either tax deferred or tax free if you have a Roth IRA. So it's going to defer your tax liability in most cases until retirement. Whereas if you're investing now with cash, obviously you're responsible for reporting that in the year that you have those earnings. The other advantage of the IRA is, or self-directed IRA, as it relates to including alternatives, is that diversification. So we've clearly seen a lot of volatility in the public markets. So even having everything in public assets can be a little scary right now. So the ability to diversify that portfolio, also knowing that alternative assets tend to yield more stable returns over a longer period of time, can be another advantage. And then really having more control over those retirement investment returns as well, in terms of building a nest egg, accelerating wealth for retirement. I don't think that any of us want to have to work for the rest of our lives. So at the same time, we know that we're somewhat limited with the resources that we have today, limited Social Security, hard to get anything like a pension plan these days. So it's really sort of more on us now as individuals to be actively managing and planning for retirement effectively.
Very nice, very nice. And what is the role as a custodian? How do you provide your value to your investors?
So as a custodian, we're responsible for holding the actual account. So if someone wants to open a self-directed IRA, they need to work with an IRA custodian that will allow these types of accounts. So as a custodian, not only do we hold the account, but we do the tax reporting and then all the record keeping and account administration to manage the funding of the account, any transaction processing, review as well of different investments, because every investment in alternative assets can be unique and different. So there is a layer of sort of a compliance review, if you will, that has to be done by the servicer to see that the investment is in line with IRS regulations. So there's certain rules and restrictions the IRS has around if you're using your IRA to make this investment, here are the things you can and can't do. It's not quite as open as using your personal funds, but then again, it's a tax advantage account, so they have oversight and they have some rules.
And that leads right in. My next question is we know, because basically, is it true that in an IRA you're investing in alternative assets, you get the tax benefits, but you don't, but you want to make sure you're compliant with the restrictions. Otherwise, the downside is you lose the tax advantages, correct?
Yes, exactly. So what you don't want to do is a prohibited transaction, which is at a very high level, using the IRA to do an investment with any disqualified person, which the IRS says are basically certain family members, like a spouse, ascendants, descendants. and anyone that might be providing a service to the account, which could present a conflict of interest, obviously can't do investments with those people. Nor can the IRA's investment benefit, like have a direct personal benefit to any of those people. So for example, like Jay, you wouldn't be able to have your spouse invest in Scottsdale REI with their IRA because of your level of involvement and control in that you're related and that relationship. So if someone were to do a prohibited transaction, there are penalties, there are steep financial consequences, and obviously our goal is for that to never happen with an investor's account. So that's why, and you asked about what value we provide. A lot of the value comes from upfront education like we're doing today, and then ongoing education, providing resources to guide investors through the process and best practices to mitigate any risk of that happening.
Great. Now let's kind of a segue to that is, so let's say somebody's interested in investing with Scottsdale, right? And so, but you're also, okay, so I'm put it this way, I'm an investor. I'm experienced. I want to be an investor. I want to get my start somewhere, right? And I want to not just be totally passive though. So how do I navigate? I've got IRA money, right? But I also want to ultimately establish investing, real estate, notes, whatever, as a business. How do I navigate that?
So if you wanted to have involvement in real estate investing on the personal side and using your IRA, you just need to separate your personal business from your IRA's investments. Is that what you're sort of getting toward with your question? Okay.
Right.
Yeah, so you wouldn't be able to use, for example, let's use you, Jay, again. You wouldn't be able to use your own IRA to invest in your own business that you personally own, nor could, if you were going to invest in something with your IRA, there couldn't be any sort of payout to you personally or any like commission that you're earning on the IRA's investment. So that all has to be completely separate. So you could certainly go out and find another investment opportunity. And especially if you own your own business and you've been very successful in investing in notes in the space and you know how to go out and find a deal, you certainly could, but it just wouldn't be able to be within your own company or, you know, benefiting your company or anything that you have.
Perfect. And yeah, I mean, like I said, with Scottsdale, we work with investors who have IRA money all the time. And as I'm not an IRA specialist, you guys do a great job of that. I'm not a tax or legal, you give me tax or legal advice. I've always kind of kept it high level saying, hey, if you want to operate as a business, go raise your own capital or or your personal funds. If you want to use your IRA money, again, not self-promoting, but park it with, a company like ours where you're a lot more passive involved. And that's kind of keeps the am I on the right track there?
Yeah, I would say, I think it's fair to say that in general, a passive investment is going to be better suited for a self-directed IRA because there's less chance and less kind of temptation to personally get involved in that. So additionally, most people that are using self-directed IRAs have full-time jobs. They may run their own businesses. Maybe they don't have the time to be managing things to their IRA actively anyway. So it may be more convenient for them anyway to be doing passive investments where as long as they've done enough due diligence on the company they're investing with or that what they're investing in and they're comfortable with that, then it may be a better arrangement for them to just have the IRA send funds out to that entity. And then obviously, as we mentioned before, if it's a note or if it's some percentage of equity, then they're just getting that passive flow back into their IRA at whatever frequency they've agreed on, depending on the investment that they're doing. So that frequency of return isn't determined by us as a custodian, it's determined by the investment, in terms of the investment that they're agreed upon.
Got it. And the elephant in the room, because I got hit with this the other day too, which I have no clue. So when does UBTI UDFI apply? I don't even know what it stands for. I mean, I kind of do, but I really don't.
Yeah, so UBTI is unrelated business taxable income. And it is a tax that could apply to a self-directed IRA if that general term usually comes into play when a self-directed IRA is investing in and sort of running its own business, if you will. So it is possible for a self-directed IRA to, purchase a business and kind of run it through the IRA. But if it is generating regular operating income, in the sense that, it's competing with other businesses down the street, for example, it could be anything. It could be like a laundromat, it could be a car wash, it could be a cafe. And if it's generating that type of operating income through the IRA more actively as well, then that UBTI could apply. So, and in most cases it would. It doesn't typically apply to any passive real estate investments, but just what I described. And it's less common because most people aren't going to do that with their IRAs, but technically they could. The other UDFI tax is more specific. That is unrelated debt finance income tax. And so that comes into play where leverage is involved. And that is more so, like an example of that would more so be someone is purchasing a real estate with their self-directed IRA and they don't have enough cash to buy the property outright, so they need a loan. If they need to get a loan and associated with that purchase, then portion of the income that is associated with the debt is subject to that UDFI tax. And then, of course, if they're paying down the debt, they're paying down the loan, that tax liability is going to decrease over time. So it's not necessarily a deal breaker for people, because then it becomes a tax, probably a CPA conversation, right? To say, okay, here are the numbers we're working with. Here's the UDFI implication. How am I making out on this deal considering the UDFI that could apply? Now, I don't know if you've come across it in your space. I don't necessarily think that you would, because you guys are buying the notes. So you're not taking out loans per se in the way that I described, correct?
Correct. And only an investor I was talking to the other day asked me that question. And in all the years I've been doing this, I've never been asked that before. Obviously, I didn't have the answer because I didn't. Yeah, I don't. But you're right. There isn't debt space when you're owning the mortgage. Remember, you're not owning the house. You're only owning the paper on the house. So there really isn't any lending, because traditional lenders don't know how to secure it. So you don't own the house to secure it with.
Yeah.
And they don't understand that the security would be the assignment of the mortgage. You're signing the paper to one party to another. So yeah, it's never come up before, but it did kind of throw me for a loop a little bit. How can mortgage notes, I think we may have touched on this, how can mortgage note investments be held within a retirement account?
So there are two general ways, and we talked with you today about the one, which is more of an indirect way, right? Someone's investing passively into an entity that's then buying up notes, and then they're getting a percentage of, what's coming out of all of that.
Right.
The other way would obviously be to buy one direct. So if somebody were to identify a specific note they want to buy with their IRA, they could clearly do that directly as well. And then essentially depending on the terms of that note, their IRA is just basically acting as the bank and collecting on it. So it's either going to be direct in the name of the IRA, or the IRA is investing in an entity and taking some equity in the entity that is then going to be buying those.
And going back to what we talked about before, if they're taking it in their own name, though, you've got to be careful of how active you're gonna. So basically, a performing note's fine because all you do is collect payments. But like a non-performing note, you probably wouldn't be able to put it in your own name, because unless you sign a note. I guess you could sign a company or us or whatever to manage it for you, because aren't you getting back into the more active involvement that would be prohibitive?
That's a great question, actually. I didn't even think about addressing that, but I'm glad you did, because we do this all day long, so it didn't even occur to me that there could be a question about that. So managing the investment from that kind of perspective is not necessarily an issue. So someone could buy the note with their self-directed IRA and kind of act as the, I guess, servicer, if you will, if they needed to. Another example of that is this is not a note example, but hopefully this provides some context. So if someone uses their self-directed IRA to buy a rental property, some of the restrictions are you can't work on the property, you can't do sweat equity, you can't do repairs, you can't live in the property, you can't rent it yourself, meaning like you can't be a tenant of the property. However, as the IRA holder, you can still visit the property, you can still oversee projects that are going on, you can negotiate with contractors if work needs to be done, you can screen tenants, you can, you can still do property management of the asset. So, but less of a tangible management, if you will, and obviously you can't pay yourself for any of those services.
Got
So,
it.
go ahead.
So in a note context, let's kind of let's go rapid fire a little bit. So you're buying a note in the IRA's name. It's a non-performing note, right? Servicer's a technical term because it's actually a third party that has to either collect your payments or managing the note, and that's federal regulated. So you're not going to be your own servicer. We're not our own servicer. That's federally regulated. But the term of art is more like an asset manager. So question, could you engage on behalf of the IRA the foreclosure attorneys you wanted to use?
Yes.
Okay. Could you call the borrower and see the borrower wants to do a loan mod?
I don't see why not.
Okay. So question of how active you could be in the management of that, because I think it might be, if you're calling the borrower, it's kind of more analogous to doing repairs on your own property. That's really kind of getting in the nitty gritty of it. Now,
yeah, I think it's less common because I don't know how many people would want to do that anyway.
And it's less common because really it's like, for example, when I run our masterminds, there's two pieces that I can't teach and one I won't teach. What I can't teach is servicing because it's too federally regulated. It's too technical on how to apply all your payments and principal and interest and manage all that. I can't teach it, right? I won't teach debt collection, even though that's my background, because I'm not going to tell you something and then Brittany takes me out of context, calls a borrower and gets herself sued. Oh, well, Jay told me this, so I'm not going to go down that road, right? And the reality of it is your third party servicers, they don't do a great job of it, but they are there to act as the person who's actually going to make the calls for you. And a lot of times they've even grown to where they're actually managing your servicers. So the answer what we'd be discussing is yes, you could buy a loan in the IRA's name and park it with a servicer, pay a full collection, which would be not the most productive use of your time, but it would certainly save you from any headaches of being too involved in your loan, because they would do all the work for you. They would be the asset manager for you, and that would work out just fine.
Yeah, and I should clarify that how I probably should have messaged that is to clarify that the IRA custodian does not service the loan or does not get involved in, the following up and tracking and doing all that.
Right.
But like you said, there are federal regulations anyway, so that should be clear. But sometimes I think there is a misconception that if someone, has a note that's being held by an IRA custodian, that the IRA custodian is going to service it.
Right. Yeah, I mean, because you get into places where you want to do this as a business. You understand that you can't pay yourself, but you want to be a note investor using IRA funds, right? And he's kind of got to walk that line and saying, hey, I don't want to do things wrong and lose my tax benefits. What does the process and timeline look like for setting up a self-directed IRA, and what should someone look for when evaluating a custodian to work with?
So the very high level conservative estimate of end-to-end process, if someone has never used a self-directed IRA, they don't have one set up, I would say conservatively from setting up the account to investment funds leaving the account 4 to 6 weeks. And that's because what's required is opening an account first. That requires having a conversation with the custodian, explaining to them what you're looking to invest in so that it can be reviewed by the custodian, or I should say cleared in terms of this is an allowable investment by the IRS in terms of what type of asset do you want to be held, and then also determining what type of IRA, what type of self-directed IRA you want to have, because you could still have a traditional Roth, SEP, solo 401k. There's still all those account types that can be self-directed. So the investor has to determine which account type they want. We can provide education on that, but we can't provide financial advice in terms of what they should open. So once they make that decision, they have to fill out an application, and it takes about a day or two to open the account and then determine how they're going to fund the account, which could be either, let's say they have an old 401k, they left a corporate job, or they have an old employer plan sitting around, maybe that they have funds in there they can roll over into the self-directed IRA. They might also just have IRAs at other institutions that don't hold real estate or notes, and maybe they want to take some of those funds out. They can do a transfer from that institution to the self-directed IRA company. Or they could make a contribution out of pocket, but those limits are going to depend on the account type that they're using to invest. So as you can imagine, lots of decisions to be made, and then lots of collaboration between different parties to even get the funds over. That's the part that usually tends to be, the most challenging piece of the process. And then once the account's open, and even if the funds are on their way, typically then the investor is going to submit that investment documentation. So for example, if they're investing with Scottsdale, what investment documents do they need to fill out and sign with you guys?
Right. If they're investing with Scottsdale, they usually, as I said, I've worked with many IRA investors. When we're doing JVs, they just want to copy the JV agreement. If we're doing syndications, they just want to copy the syndication agreement. And that's usually sufficient for them, for the custodian to, put the deal together.
Right.
And so we have a question. So UBTI would apply to something like an Airbnb, but not a note or long-term rental property?
So I'm not aware of it applying to Airbnb either. I haven't seen a whole lot of that. And that would probably be a better question to double check with a tax advisor, because the concept of UBTI and UDFI is not just limited to self-directed IRAs, but something that any tax advisor should be aware of. So I can just say high level from my own experience, I haven't seen that UBTI applies for Airbnb, but it would not for a note or long-term rental property. That's correct.
Got it.
Just to finish up on that conversation about the process. So for example, you said that there's a JV agreement and some other documents. So the custodian would request that documentation from the investor. So they'd almost fill it out just like they normally would with you if they were investing personally, but then in the place of their personal name, they would put their self-directed IRA name. They review and initial everything, but then the custodian has to do a full review, which could take several days to just check the accuracy of the information, make sure that if they see anything that would constitute a blatant prohibited transaction, obviously they have the chance to stop that. And then with that, the custodian is going to be the one to actually sign on behalf of the IRA, sign those documents. So there's some collaboration involved in that piece of the process too. And then at the conclusion of the review, then the funds would be deployed from the IRA out to the receiving entity or individual, et cetera. And then any payments flow back to the custodian to be deposited, payable to that person's IRA.
Great.
You asked about what should individuals look for when evaluating custodians. I think that one thing that's important to grasp is that investing with a self-directed IRA and alternative assets is different from the traditional model of, Fidelity brokerage account, for example, right? It's easy to be very automated and self-service with that kind of approach. Because you have a bunch of approved products on a platform. So if you're buying stock in Apple or whatever, you can just press a button and do that. But when we're talking about alternative assets, everything's unique and different, can be pretty customized. It's really important to work with a custodian that has good customer service, because as an investor, you need to be able to get answers to your questions, get guidance from them. Know what is expected of you and be clear on those expectations, and then have quick responses to your questions so that if you need to meet a specific investment deadline, that you're tracking efficiently toward that deadline. So I think looking at how can you get in touch with that custodian? Do they make it easy to reach them? Are you going to be on hold for an hour if you try to call? Is there a specific person that you can actually talk to? How quickly do they get back to you if you're submitting questions? All those things I think are really important to look at.
Got it. Erica, do we have any other questions?
We do not at this time. So if you guys are ready to wrap up, we can get into some polling. And then, you know, obviously closing. So do you guys have anything else to add?
No, I think we're
Not
good.
good.
Okay, so at this point of the webinar, we're going to be wrapping up. We would like to learn a little bit more about the individuals that are joining here today. So we're going to do some polling. In the meantime, I'd like for the both of you to please paste your contact information into the chat so that the audience has it in case they'd like to reach out. And in the meantime, we'll get started with the polling. So our first question is, do you have any existing retirement and or savings accounts? So that could be an employer plan, like a 401k, a 403b, a pension, etc., a traditional or Roth IRA, a STEP, a simple, a solo K, or a health savings account or education savings accounts. All of these account types can be self-directed. So I'll give everyone a couple of seconds. Let everyone get their answers in. Okay, we'll wrap this one up and share the results. So it looks like the majority have a traditional Roth IRA or an employer plan. And then we have some with SEPs or a health savings account. So that's definitely a good, healthy mix. Our next question is retirement account balance. So what is the balance of your retirement accounts? We'll launch that one. Okay, we'll end that one and share the results. So it looks like a good, healthy mix. Definitely some good available funds for some alternative investments. And then our final question. So obviously we're here today to talk about mortgage notes, but we would like to know if there's any other types of investments that you're interested in. So like we were talking about earlier, obviously real estate, there's private equity, crypto, lending, precious metals, and then impact and ESG investments, which may be more suited for those that are looking to invest in things that are more in line with some of their values. Okay, a few more seconds on that one. And we'll share the results. Obviously, the majority, no surprise, real estate and lending, which is why we're here today. Some private equity, crypto, and precious metals. So definitely a good, healthy mix. Okay, so with that, Britt, you're muted.
Oh, I was going to say you came to the right place then.
Oh yes, definitely
Right.
came to the right place. So with that, thank you guys for participating. For those of you who will be watching this on demand, I just want to reiterate some of our speakers' contact information. So Brittany can be reached at brittanym@nextgenerationtrust.com, phone number 973-533-1880. And she did paste a very helpful link, which I was going to share, our link tree, which when you click that, will give you links to our blog, our white paper library, all of our on-demand webinars. This one will make it on there tomorrow. You can sign up for our monthly newsletter or register for a complimentary educational session with one of our representatives one-on-one. And I am also going to paste another link next month on April 13th. We're going to be hosting a networking session, which will be great for anyone looking to connect with investment sponsors, any other financial professionals, us. If you have any SDIRA related questions, we will be doing an open Q&A during that session so that you can learn more about self-directed IRAs. And anyone else that you may be looking to meet, definitely sign up if you have the time. It's going to be April 13th at 12 p.m. Eastern. So definitely register for that if you'd like to join us again. And with that, I think we're good. And we hope to see you on the next one. So thank you, Jay. Thank you, Brittany. And we hope everybody has a great day.
Thank you.
Thanks so much. Have a good day.